If you've been around the world of personal finance for a while, you've probably heard Dave Ramsey's name. He's a household legend when it comes to getting out of debt and building wealth. But what you might not know is that his investing advice is just as powerful as his debt-free teachings. So if you're looking for a simple, no-nonsense guide to investing that actually works, you're in the right place. You are watching Prosperity Pulse Point. I'm going to break down the exact steps Ramsey recommends to get your money working for you, from paying off debt to investing 15% of your income in mutual funds. And in the end, because I'm also going to share one tip that might help new investors a lot. Chapter 1. Get out of debt and save up. Let's start with the foundation, getting out of debt and building a fully funded emergency fund. I know this isn't the most exciting part of investing, but it's absolutely critical. Here's why. Debt is like an anchor weighing down on your financial future. High interest debt, especially credit cards and personal loans, can quickly erase any gains you make from investing. Think about it. What's the point of earning 8% in the stock market if you're paying 20% on your credit card balance? It's like trying to fill a bucket with a giant hole at the bottom. That's why Dave Ramsey insists that before you start investing, you need to be debt-free, with the exception of your mortgage. This is baby step 2 in his plan. Once you're out of debt, you move on to baby step 3, which is saving up 3 to 6 months of expenses in a fully funded emergency fund. Why an emergency fund? Because life happens. Whether it's an unexpected car repair, a medical bill, or a sudden job loss, having this cushion prevents you from dipping into your investments, or worse, going back into debt. It's a safety net that allows us to stay focused on your long-term goals. So before we even think about investing, the first step is clearing the debt and building that emergency fund. It's like laying a rock-solid foundation for the wealth you're about to build. Chapter 2. Invest 15% of your income. Okay, now that you're debt-free and have a solid emergency fund, let's talk about the next step. Investing 15% of your income into tax-advantaged retirement accounts. This is where your money really starts to work for you. So why 15%? Dave Ramsey believes this is the sweet spot. It's enough to build a substantial retirement nest egg without forcing you to live on beans and rice today. The key here is consistency. By investing 15% of your gross income every month, you'll take advantage of the power of compound interest. And trust me, compound interest is the magic sauce of wealth building. It's like earning interest on your interest, and over time, it can lead to massive growth. Now, Dave emphasizes using tax-advantaged accounts to supercharge your retirement savings. Think of accounts like 401ks, IRAs, and Roth IRAs. These accounts allow your money to grow either tax-free or tax-deferred, which means you're keeping more of what you earn and letting the government take less of a bite. For example, if your employer offers a 401k match, you must take advantage of it. It's literally free money. Imagine someone offering you an extra 3 to 5% on top of your salary just for investing in your future. You wouldn't turn that down, right? If you max out your 401k or don't have one through your job, the next step is to look at IRAs, either traditional or Roth. A Roth IRA is especially powerful because while you invest with after-tax dollars, your money grows tax-free, and you don't pay taxes when you withdraw it in retirement. So by investing 15% consistently in tax-advantaged accounts, you're setting yourself up for a secure retirement where your money has the best chance to grow, and you're not giving Uncle Sam more than you have to. Chapter 3. Invest in good growth stock mutual funds. Now that you're investing 15% of your income, let's talk about where to put that money. According to Dave Ramsey, the best place to invest for the long haul is in good growth stock mutual funds. Now, if you're not familiar with mutual funds, don't worry, I've got you covered. A growth stock mutual fund is a collection of stocks from companies that are expected to grow faster than the market average. Instead of buying individual stocks and trying to guess which ones will do well, a mutual fund allows you to pool your money with other investors and own small pieces of lots of different companies. This gives you instant diversification, which helps you reduce your risk while positioning you for growth. Dave Ramsey recommends splitting your mutual fund investments into 4 categories: growth, growth and income, aggressive growth, and international. Here's why. This spread helps you balance risk and return. Growth funds focus on companies with strong potential for increase in value. Growth and income funds provide a more stable return by focusing on dividend-paying stocks. Aggressive growth funds target higher risk, higher reward opportunities. And international funds give you exposure to companies outside the US, which can be a good hedge against economic shifts. Why mutual funds over other options like bonds or index funds? Ramsey believes that actively managed growth stock mutual funds with a solid track record give you the best potential for long-term gains. He's all about focusing on funds with at least a 10-year history of strong performance. This way, you're investing in funds that have weathered market ups and downs and come out ahead. By choosing good growth stock mutual funds, you're setting your money up for success over the long term, with a balance of diversification and the potential for serious growth. Chapter 4. Keep a long-term perspective. Now let's talk about one of the most important aspects of successful investing: keeping a long-term perspective and investing consistently. This is where a lot of people struggle, especially when the market gets bumpy. The truth is, the stock market will go up and down. That's just the nature of investing. But here's the key. If you stay the course and keep investing consistently, history shows that you'll come out ahead in the long run. This is where Dave Ramsey's advice really shines. He encourages us to take a long-term approach, looking 5, 10, or even 20 years down the road, rather than focusing on the day-to-day fluctuations. This is why dollar cost averaging is so powerful. By investing a set amount of money regularly, whether the market is up or down, you're buying more shares when prices are low and fewer when prices are high. Over time, this strategy helps to smooth out the market's volatility and puts you in a stronger position for growth. It's all about patience and discipline. Dave Ramsey reminds us not to panic when the market dips. Instead, keep your emotions in check, stay invested, and remember that historically, the market has always trended upward over the long term. When you invest consistently with a long-term perspective, you give yourself the best chance to build lasting wealth. Chapter 5. Working with a Financial Advisor. Finally, let's talk about working with a financial advisor. Now, I know some people are hesitant to bring in professional help, but the right advisor can make a huge difference in your financial journey, especially if you're feeling overwhelmed by all the choices. Dave Ramsey is a big believer in finding a financial advisor who has the heart of a teacher, someone who isn't just there to sell you products, but to genuinely help you understand your investments and make informed decisions. They should guide you, educate you, and ultimately help you stay on track with your financial goals. But here's an important tip. Make sure your advisor is a fiduciary. That means they're legally obligated to act in your best interest, not just to push products that might earn them a commission. Fee-only advisors tend to be a better bet because their advice is tied to your success, not their sales. And if you're not sure where to start, Dave Ramsey's network of endorsed local providers, or ELPs, is a great resource. These advisors are trained in his principles and can help you make smart, long-term investment decisions. Remember, a good advisor is an ally in building your wealth, so choose wisely. And there you have it, the golden principles of investing, straight from Dave Ramsey's playbook. Remember, building wealth is a marathon, not a sprint. Stick to the plan, stay consistent, and you'll see the results over time. If you found this video helpful, please give it a thumbs up. It really helps the channel. And don't forget to subscribe for more practical, no-nonsense financial advice. I'd love to hear your thoughts, so drop a comment below and let me know what investing strategies you're using. Thanks for watching, and I'll see you in the next video.